There is a question that haunts the world of finance, a puzzle that has been studied in business schools and debated on trading floors for over half a century. How does one man, operating from a quiet office in Omaha, Nebraska, consistently outperform the sharpest minds on Wall Street? How does Warren Buffett, armed with little more than an annual report and a can of cherry Coke, make investment decisions with a clarity and success rate that seem almost superhuman? The common assumption is that it's the result of some arcane financial modeling, some proprietary algorithm, or weeks of exhaustive, mind-numbing research for every single decision. But the truth is far more elegant and infinitely more powerful. Buffett doesn't start with a spreadsheet. He starts with a checklist. A simple, four-part mental filter that he runs every potential investment through in a matter of minutes. This framework is his weapon against complexity, his antidote to the analysis paralysis that cripples millions of investors. It's the tool he uses to instantly discard 99% of the opportunities that cross his desk, allowing him to focus his formidable intellect only on the handful of potential grand slams. This isn't a story about complex math. It's a story about profound simplicity. Today, we are not just going to talk about this framework. We are going to install it into your own thinking. We will deconstruct each of the four filters piece by piece so that by the end of this journey, you will possess the mental lens to see the world of business through his eyes. This is the blueprint to his first 15 minutes. This is the key to his lifelong success. The first filter, the great gatekeeper of Warren Buffett's mind, is deceptively simple. It is a question he asks himself before any other, a hurdle that any company must clear before it is worthy of even a moment more of his attention. The question is this: is this a business I can understand? This isn't a test of intelligence, it's a test of intellectual honesty. Buffett calls it the circle of competence. The idea is that each of us, through our experiences, our careers, our studies, and our passions, has built up a specialized knowledge in certain areas. For some, it might be software development. For others, it might be retail logistics, or insurance, or even the economics of a local restaurant franchise. Inside this circle, we have an edge. We understand the nuances, the competitive dynamics, the language of the industry. Outside of that circle, we are operating in the dark, vulnerable to hype, misunderstanding, and the persuasive narratives of others. Buffett's first rule is to never, ever step outside of that circle. The quintessential story illustrating this principle, the one that perfectly captures its power and practicality, is the acquisition of See's Candies in 1972. At that time, Buffett and his partner Charlie Munger were still predominantly practitioners of what they later called cigar butt investing. They were disciples of Benjamin Graham, hunting for statistically cheap companies, often mediocre businesses trading for less than their liquidation value. They would buy a stock, wait for a small pop in price, and sell. It was a quantitative game. See's Candies was different. It was qualitative. It wasn't a statistically cheap cigar butt. It was a wonderful business, and it wasn't being offered at a bargain basement price. The company was being sold by the See family for $30 million. Buffett and Munger, after their initial analysis, thought it was worth no more than $25 million. Their first instinct, the old cigar butt instinct, was to walk away. But something about the business held their attention. It was simple. It was, in a word, understandable. Imagine walking into a See's Candy store in the early 1970s. The crisp white uniforms of the staff, the gleaming glass cases, the rich, intoxicating smell of chocolate. The business model could be grasped in a single sensory experience. They made high-quality chocolates using premium ingredients. They sold these chocolates in their own stores, primarily on the West Coast, for a premium price. The transaction was clean and immediate. Cash for candy. There were no complex receivables, no arcane accounting, no technological risks that could render the entire operation obsolete overnight. But the real genius of the business, The part Buffett and Munger understood on an intuitive level was the brand. See's Candies was more than just a product. It was a deeply embedded part of the customer's life. A box of See's was a ritual. It was a gift for Valentine's Day, a staple for Christmas, a gesture of apology, a token of celebration. This emotional connection created what Buffett would later call a moat around the business. A customer who was conditioned to give a box of See's to his sweetheart on Valentine's Day wasn't going to risk switching to a cheaper, unknown brand to save $1 or $2. The potential emotional cost of that decision far outweighed the financial savings. This gave See's incredible pricing power. They could raise their prices year after year to cover inflation and then some, and the customers wouldn't blink. The brand was a reservoir of goodwill stored in the minds of millions of consumers. Buffett and Munger's final decision came down to a negotiation. They offered $25 million, a figure derived from their fundamental analysis of the assets and earnings. The seller held firm at $30 million. A friend and intermediary, Robert Flaherty, urged Buffett to reconsider. "You guys are crazy," he told them. "This is a business you can understand. It's a wonderful business." He was right. That final $5 million gap was a rounding error compared to the long-term value of a business with such a simple, powerful, and understandable economic engine. They relented and paid the full price. That $25 million investment, initially deemed too high, has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway. It was the investment that fundamentally changed their approach, shifting them from buying fair companies at wonderful prices to buying wonderful companies at fair prices. And it all began with that first filter. They understood every moving part of the See's Candies machine. They understood the psychology of the customer, the simplicity of the cash-based transactions, the durability of the brand, and the resulting pricing power. There was no technological risk they couldn't model, no complex financial derivative they had to unpack. It was a business that fit squarely inside their circle of competence, and that clarity gave them the conviction to make a bet that would alter the course of their careers and become a cornerstone of their investment strategy. The psychological principle underpinning Buffett's first filter is a powerful defense against one of the most pervasive and dangerous cognitive biases, the Dunning-Kruger effect. This is the phenomenon where people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. The world of investing is a minefield for the Dunning-Kruger effect. The constant barrage of financial news, the endless parade of expert predictions, and the easy access to trading platforms create a potent illusion of knowledge. An amateur investor reads a few articles about biotechnology, learns a couple of buzzwords like CRISPR or mRNA, and suddenly feels qualified to pick the next big winner in the pharmaceutical industry. They mistake familiarity with jargon for genuine understanding. They don't know what they don't know, and that is a fatal flaw in a domain where a single mistake can have catastrophic financial consequences. Buffett's circle of competence is a form of cultivated intellectual humility. It's a preemptive strike against the brain's natural tendency towards overconfidence. Our brains are wired to seek patterns and create narratives, even where none exist. When faced with a complex new technology or a convoluted business model, the ego-driven impulse is to pretend we understand it, to nod along, to avoid looking foolish. We fear asking the stupid question. Buffett inverts this. He believes the truly stupid thing is to risk capital on something you can't explain. He is famous for saying he wants to invest in businesses that are so simple they could be run by an idiot, because sooner or later, one will. This isn't an insult to the management of his companies, it's a testament to the robustness of the business model itself. He is actively seeking businesses where the core economics are so clear and durable that they are not dependent on the once-in-a-generation genius of their leadership or the vagaries of a rapidly changing technological landscape. This approach directly counters the allure of complexity. Wall Street loves complexity. It creates fees. It allows mediocre minds to hide behind a smokescreen of jargon and complicated financial products. But Buffett understands that in investing, complexity is the enemy of value. Simplicity is where the real, durable advantage lies. By forcing himself to stay within his circle, he is not limiting his opportunities. He is ensuring that for every investment he makes, he is playing with a stacked deck. He is competing on his home turf, where his knowledge is deep and his judgment is sound. It's a powerful psychological discipline that transforms the vast, intimidating universe of stocks into a small, manageable pond where he is the expert fisherman. This rigorous self-assessment is a core tenet of the intelligent investor, prioritizing the avoidance of error over the pursuit of speculative gains. So how can we, as individual investors, translate this powerful principle into a practical, repeatable process? The blueprint for applying the circle of competence filter is a simple but ruthless exercise I call the explain it to a child test. It's a mental model designed to strip away all jargon and force you to confront the raw reality of a business. It's a crucial first step in any stock analysis. The process has 5 distinct steps. First, pick any company you are considering investing in. Let's say it's a popular tech company. Before you look at its stock chart, before you read a single analyst report, take out a blank piece of paper. Step 2. At the top of the paper, write down, in no more than 3 sentences, exactly how this company makes money. Be specific. Don't say they sell software. Say, they charge businesses a recurring monthly subscription fee based on the number of employees who use their cloud-based project management tool. If you cannot articulate this with absolute clarity and simplicity, you have already failed the test. The business is outside your circle. Step 3. Identify the company's core customer and the fundamental problem it solves for them. Who is paying the bills? Is it a teenager buying a video game? Is it a Fortune 500 company managing its supply chain? And what pain point is being addressed? Is it boredom, inefficiency, the need for social connection? A business that doesn't solve a real problem for a real customer has no reason to exist. If you can't define this relationship simply, you don't understand the foundation of its value. Step 4. List the 3 biggest risks that could permanently impair the company's earning power. This is the most critical part of the exercise. You must think like a pessimist. What could kill this business? A change in consumer taste? A new technology? A powerful competitor? Increased regulation? If you can't come up with specific, plausible threats, it's not because the business is invincible. It's because your understanding is too superficial. You are seeing only the promise, not the peril. Finally, step 5. Take your simple explanation from the previous steps and try to articulate it out loud to someone who knows nothing about the industry, like a spouse, a friend, or even just imagine explaining it to an intelligent 12-year-old. If you find yourself stumbling, using industry jargon, or waving your hands and saying it's complicated, you have failed. The "it's complicated" response is a blaring red siren, a confession that the business resides outside your circle of competence. This entire process, a key part of any serious due diligence, should take no more than 5 minutes. It's a rapid-fire test of your own understanding. Passing this test doesn't mean you should buy the stock. It simply means the company is worthy of moving to the next filter. It grants you permission to continue your research. The antithesis of this disciplined approach, the path trodden by 99% of market participants, is the siren song of the incomprehensible. It is the belief that the greatest rewards lie hidden in the most complex and exciting stories. There is no more tragic and spectacular example of this folly than the dot-com bubble of the late 1990s. This was a period when the circle of competence was not just ignored, it was actively ridiculed. Investors, both amateur and professional, stampeded into companies with no revenues, no profits, and in many cases, no viable business model. They bought stories, not businesses. Companies like Pets.com, Webvan, and eToys became household names with multi-billion-dollar market capitalizations. If you had applied the explain it to a child test to Pets.com, what would you have found? The business model was to sell pet supplies online and ship them to people's homes. The fundamental problem with this, which was obvious to anyone with a basic understanding of logistics and economics, was that they were selling heavy, low-margin bags of dog food and shipping them at a massive loss. The unit economics were disastrous. They were literally losing money on every sale, hoping to make it up in volume, a classic recipe for financial ruin. But nobody cared about the economics. They cared about the narrative. The story was about the new paradigm, the internet revolution that was going to change everything. Old metrics like earnings and cash flow were dismissed as relics of a bygone era. The new metric was eyeballs or user growth. The financial world was gripped by a collective madness, a classic herd bias, where the fear of missing out overwhelmed the capacity for rational thought. And where was Warren Buffett during this frenzy? He was on the sidelines, being openly mocked. He was called a dinosaur, a man who'd, quote, didn't get it. Magazine covers questioned if he had lost his touch, and his response was simple and unwavering. He didn't invest in things he didn't understand. He couldn't predict which of the hundreds of competing tech companies would win, and he had no special insight into their long-term competitive advantages. He stayed firmly within his circle of competence, investing in businesses like insurance, furniture, and Coca-Cola. When the bubble burst in 2000 and trillions of dollars of speculative wealth evaporated, those who had chased the complex and exciting stories were financially and emotionally devastated. The path of the 99% had led directly off a cliff. Buffett, the dinosaur, was proven to be the wisest of them all. His adherence to that first simple filter hadn't just protected his capital, it had positioned him to pick up the pieces of wonderful, understandable businesses that were put on sale in the aftermath of the crash. The direct financial connection between the circle of competence and your portfolio's performance is profound and tangible. It is the bedrock upon which all sound financial analysis is built. When you invest in a business you truly understand, your ability to forecast its future financial performance becomes exponentially better. Your projections for revenue growth, profit margins, and free cash flow are grounded in a qualitative understanding of the business, not just a quantitative extrapolation of past trends. This has a massive impact on any valuation method you use, particularly a discounted cash flow (DCF) analysis. A DCF model is exquisitely sensitive to its inputs. If you don't understand the business, your assumptions about its long-term growth rate and profitability are, frankly, guesses. Garbage in, garbage out. A poorly understood business leads to a meaningless valuation, which in turn leads to poor investment decisions. Furthermore, a deep understanding of the business is your single greatest defense against market volatility. When the stock of a company you own drops 30% because of a market-wide panic, your reaction is determined entirely by the strength of your conviction, and that conviction is born from understanding. If your understanding is based on a hot tip or a slick analyst report, you will feel fear. You will see the falling price as a validation that you've made a terrible mistake, and you will be tempted to sell at the worst possible moment, locking in a permanent loss of capital. But if you have done the work, if you have passed the company through the explain it to a child test, if you understand its customers, its products, and its competitive position, your reaction will be entirely different. You will see the panic as an opportunity. You will reevaluate your thesis, and if the fundamental business remains unchanged, you may even see the lower price as a chance to buy more of a wonderful business at an even more attractive valuation. This psychological fortitude, the ability to act rationally when others are panicking, is one of the greatest advantages an individual investor has. It is a direct result of staying within your circle of competence. It transforms you from a speculator, tossed about by the whims of the market, into a genuine business owner, focused on the long-term performance of your assets. This discipline is the first and most critical step towards building lasting wealth. Once a company has passed through the first gate and proven itself to be understandable, it faces Buffett's second filter. This is where he separates the good businesses from the truly great ones. The question he asks is, does this business have favorable long-term prospects? This is another way of asking if the company has a durable competitive advantage, what Buffett and Munger famously refer to as an, Quote, economic moat. A moat is a protective barrier that shields a business from competition, allowing it to earn high returns on capital for a very long period of time. Just as a medieval castle used a wide moat filled with water to fend off invaders, a great business must have a structural advantage that keeps competitors at bay. This is not about a company having a good quarter or even a good year. It's about having an economic structure so powerful that you can confidently predict it will be a dominant force in its industry 10, 20, or even 50 years from now. The search for these economic castles is a cornerstone of Buffett's investment strategy for long-term building of wealth. The story that best personifies the search for a deep, wide, unbreachable moat is Buffett's landmark investment in the Coca-Cola Company in 1988. The context of the time is crucial. The market was still reeling from the Black Monday crash of October 1987, when the Dow Jones Industrial Average plummeted by over 22% in a single day. Fear was rampant. Investors were dumping stocks indiscriminately, desperate to get to the safety of cash. It was in this environment of extreme pessimism that Buffett saw an extraordinary opportunity. He had been a consumer of Coca-Cola for over 50 years, drinking at least 5 cans a day. He understood the product, but his investment thesis was not built on his personal taste. It was built on a cold, hard analysis of the company's economic moat. He began to think deeply about what made Coke so special. He went to the company's headquarters in Atlanta and spent time in their archives, studying the history of their brand building and global expansion. He saw a business that wasn't just selling flavored sugar water, it was selling an idea, an emotion. The moat around Coca-Cola was not a patent or a factory. It was a fortress built in the collective consciousness of billions of people around the globe. He famously quantified this moat with a mental exercise. He would ask himself, if he were given $100 billion and the task of unseating Coca-Cola from its dominant position in the soft drink market, could he do it? The answer was a resounding no. You could build bigger factories, you could create a better tasting formula, you could design a more attractive bottle. But how could you possibly dislodge the memories and associations that people had with Coke? How could you erase a century of branding that had successfully linked the product with happiness, celebration, family, and Americana? Coke had achieved something remarkable. It had captured share of mind. When someone, anywhere in the world, thought of having a refreshing drink, the word Coke would almost involuntarily pop into their head. This mental real estate was an intangible asset of almost incalculable value. It gave the company immense pricing power. It could pass on rising input costs to consumers without fear of them switching to a generic alternative. Its global distribution system was another part of the moat, a massive, capital-intensive network that would be nearly impossible for a competitor to replicate. By the late 1980s, over half of Coke's sales were international, and that business was growing at a phenomenal rate. In the midst of the post-crash gloom, Buffett saw a dominant global franchise with an unassailable competitive advantage, trading at a reasonable price. He acted with conviction. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a stake in the Coca-Cola Company. It was, at the time, one of the largest single investments he had ever made. Many on Wall Street were skeptical. They saw a mature, slow-growing American company. Buffett saw a global powerhouse with a moat as wide as the ocean. His analysis proved to be spectacularly correct. The investment in Coca-Cola became one of the most successful in Berkshire's history, generating billions of dollars in dividends and capital gains. It was a masterclass in applying the second filter, looking past the short-term noise of the market and focusing on the long-term, durable competitive advantage of a truly great business. The psychological principle that makes economic moats so powerful is deeply rooted in human behavior, specifically our tendency towards the status quo bias. This is our innate preference for the current state of affairs. Any change from the baseline is perceived as a loss. Great businesses with wide moats exploit this cognitive shortcut brilliantly. Think about your own behavior. Why do you use the same bank you've used for a decade, even if another bank offers a slightly better interest rate? Because the perceived hassle of moving direct deposits, automatic payments, and learning a new online interface, the switching cost, is too high. The status quo feels safe and easy. This is a type of moat. Why does a surgeon continue to use medical devices from a company they trained on, even when a new competitor offers a technically superior product? Because the cost of retraining and the risk of a negative patient outcome from using an unfamiliar tool are enormous. That's another powerful switching cost. Brands like Coca-Cola or Apple leverage this bias in a more emotional way. They create a powerful brand association, a mental heuristic that simplifies our decision-making process. The world is a complex place with an overwhelming number of choices. A strong brand acts as a trusted guide, a signal of quality and consistency that reduces our cognitive load. When you buy an iPhone, you're not just buying a phone. You're buying into an ecosystem you understand, a user experience you trust, and a certain social status. The thought of switching to an Android device involves learning a new operating system, transferring all your data, and leaving the familiar comfort of the Apple ecosystem. For most people, the status quo is simply easier and more reassuring. A company with a wide moat, therefore, isn't just selling a product, it's selling certainty. It's embedding itself into the habits, routines, and even the identity of its customers. This creates a loyal, recurring revenue stream that is remarkably resilient to competition. Recognizing the power of this psychological inertia is a key step in learning how to analyze companies like a world-class investor. It's about understanding that the best businesses are not just better, they are stickier. To make the concept of an economic moat a practical tool in your investment checklist, you can use a blueprint I call the 5 forces of the moat. This is a simplified framework, inspired by Michael Porter's famous model, that helps you identify and categorize the specific sources of a company's competitive advantage. When you analyze a business, you should be able to point to at least one, and preferably more, of these 5 forces. First, there are intangible assets. This includes things like brands, patents, and regulatory licenses. A brand like Nike or Disney creates an emotional connection and pricing power that is nearly impossible to replicate. A patent gives a pharmaceutical company a temporary monopoly on a blockbuster drug. A regulatory license, like the one required to operate a railroad or a utility, creates a legal barrier to entry. The second force is switching costs. As we discussed, these are the one-time inconveniences or expenses a customer incurs to switch from one product to another. Enterprise software companies like Microsoft or Oracle are masters of this. Once a company has built its entire workflow around their software and trained thousands of employees to use it, the cost and disruption of switching to a competitor are immense. The third force is the network effect. This occurs when the value of a product or service increases as more people use it. A telephone was not very useful when only 2 people had one. A social media platform like Facebook or a payment network like Visa becomes more valuable to each user with every new person who joins the network. This creates a powerful winner-take-all dynamic. The fourth force is cost advantage. This can come from 2 main sources: process and scale. A company like Walmart uses its immense scale to negotiate lower prices from suppliers than any of its competitors can, allowing it to offer lower prices to customers. A company like Geico, with its direct-to-consumer model, has a structural cost advantage over insurance companies that rely on a network of agents. The final force is a niche market, sometimes called a toll bridge. This is a business that dominates a small, specific market so thoroughly that it becomes the only game in town. For example, a company that provides the mission-critical software for dental offices might not be a household name, but it has a virtual monopoly in its niche. By systematically running a company through this 5-part checklist, you can move from a vague feeling that a company is good to a precise identification of its economic moat, the source of its long-term power. The path of the 99% is littered with the carcasses of companies that had a temporary advantage but lacked a durable moat. The failure to distinguish between the two is one of the most common and costly mistakes in investing. A perfect case study in this antithetical approach is the rise and fall of BlackBerry, formerly known as Research in Motion. In the mid-2000s, BlackBerry was not just a company, it was a phenomenon. Its devices, with their physical keyboards and secure email service, were ubiquitous in the corporate world. They had a powerful network effect through their BlackBerry Messenger (BBM) service, an exclusive messaging platform for BlackBerry users. The company was wildly profitable, and its stock soared. Many investors looked at BlackBerry and saw an unassailable moat. They saw the brand, the corporate contracts, and the network effect, and they believed it was the next great technology dynasty. But their moat was a mirage. It was built on a specific technological paradigm that was about to be rendered obsolete. When Apple launched the iPhone in 2007, it fundamentally changed the game. The iPhone wasn't just a better phone, it was a different kind of device entirely, a powerful, pocket-sized computer with a full-featured web browser and a revolutionary app store. The management at BlackBerry was dismissive. They couldn't imagine a world where business executives would type on a glass screen. They were blinded by their own success, a classic case of what is sometimes called institutional imperative. They failed to see that their moat was not deep enough to withstand a tectonic shift in the industry. The iPhone's superior user experience and the vast ecosystem of apps created a value proposition that BlackBerry simply couldn't match. Their network effect on BBM was quickly made irrelevant by cross-platform messaging apps like WhatsApp. Their brand, once a symbol of corporate power, began to look dated and clunky. The company that once seemed invincible saw its market share and stock price collapse in a remarkably short period of time. Investors who had mistaken BlackBerry's temporary product leadership for a durable economic moat were financially decimated. This is the critical lesson. A great product is not a moat. A hot trend is not a moat. A true moat is a structural advantage that protects a business from competition, even when the technological landscape shifts. The 99% chase the hot product. The intelligent investor seeks the durable structure. The direct financial connection between a wide economic moat and a company's financial statements is clear and quantifiable. It manifests primarily in two key areas: high returns on invested capital, ROIC, and consistent, growing free cash flow. ROIC is a measure of how efficiently a company is using its capital to generate profits. In a perfectly competitive industry with no moats, competition would drive ROIC down to the company's cost of capital. A business that can consistently generate an ROIC of 15, 20, or even 30% is demonstrating that it has a powerful competitive advantage that is protecting it from this process. The moat allows the company to price its products or services well above its costs, leading to high profit margins. Furthermore, a wide moat directly impacts a company's free cash flow, which is the lifeblood of any business and the ultimate source of its intrinsic value. A company in a hyper-competitive industry must constantly reinvest a huge portion of its earnings back into the business, in research and development, in marketing, in price wars, just to stay in the game. It's like running on a treadmill. You have to run faster and faster just to stand still. A company with a wide moat, however, is a different story. Coca-Cola doesn't need to reinvent its core product every year. Its brand does the heavy lifting. This means a larger portion of its earnings can be returned to shareholders in the form of dividends and share buybacks, or be used to make value-accretive acquisitions. This ability to gush cash, year after year, without requiring massive capital reinvestment, is the financial signature of a great business. When you are conducting your fundamental analysis, look for a long history of high and stable ROIC and a consistent ability to generate free cash flow. These numbers are the quantitative proof of the qualitative concept of an economic moat. They are the tangible evidence that you have found one of the rare economic castles that can compound your wealth for decades to come. After a business has proven itself to be both understandable and protected by a durable competitive advantage, it arrives at Buffett's third and perhaps most nuanced filter. This is where he moves from analyzing the business to analyzing the people running it. The question is the business operated by able and trustworthy management? Buffett has often said that he prefers to bet on the jockey, not just the horse. A great business, the horse, can be run into the ground by a poor manager, the jockey. Conversely, a truly exceptional manager can take a good business and elevate it to greatness. This filter requires a judgment of character as much as a judgment of skill. Buffett is looking for two distinct qualities that must exist together: ability and integrity. Ability without integrity is dangerous. The manager might be smart enough to cook the books or engage in reckless, self-serving behavior. Integrity without ability is ineffective. The manager might be a wonderful person but lack the business acumen to allocate capital effectively and navigate a competitive landscape. Finding a management team that possesses both in abundance is the third critical piece of the investment puzzle. The story that best encapsulates Buffett's focus on management quality is his long and profitable association with Tom Murphy, the legendary CEO of Capital Cities/ABC. Buffett's admiration for Murphy is almost boundless. He has repeatedly called him the best business manager he has ever met. Their relationship began in the 1970s, but the defining moment came in 1986 when Capital Cities, a relatively small broadcasting company, announced its audacious plan to acquire the much larger ABC network. To finance the deal, Murphy needed capital, and he turned to Buffett. Buffett didn't just provide a loan, he became a major equity partner, investing over $500 million in the newly merged company. His decision was based less on a detailed analysis of the television network industry and more on his profound faith in Tom Murphy and his longtime partner Dan Burke. What made Murphy so special in Buffett's eyes? It was his unique combination of extreme rationality and personal integrity. Murphy ran Capital Cities with a philosophy of radical decentralization. He hired the best people he could find, gave them the resources they needed, and then got out of their way. He hated corporate bureaucracy, lavish overhead, and the kind of imperial CEO behavior that was common at the time. His focus was relentlessly on cash flow and prudent capital allocation. After the ABC acquisition, Murphy applied this same lean, rational approach to the bloated network. He sold the company's corporate jet, eliminated excessive executive perks, and instilled a culture of cost consciousness and operational excellence. But he did it with a sense of fairness and respect that earned him the loyalty of his employees. His shareholder letters were models of clarity and candor, openly discussing challenges and mistakes. He was the antithesis of the slick, self-promoting CEO. Buffett's investment was a spectacular success. Under Murphy's leadership, Capital Cities/ABC became one of the most profitable and best-run media companies in the world. The lesson for Buffett was clear. When you find a manager with the rare combination of talent, passion, and integrity, you should bet heavily on them. In contrast, Buffett also had experiences that reinforced the importance of this filter from the negative side. His ordeal with Salomon Brothers in the early 1990s, where a rogue trader scandal threatened to bring down the entire firm, forced him to step in as interim CEO. He saw firsthand how a culture of greed and a lack of integrity at the top could rot a company from the inside out, regardless of the talent of its individual employees. These experiences solidified his belief that management quality is not a soft factor. It is a hard, critical component of a company's long-term value. The psychological principle at play when we assess management is our vulnerability to the halo effect. This is a cognitive bias where our overall impression of a person influences our evaluations of their specific traits. If a CEO is charismatic, articulate, and projects an aura of confidence, we are psychologically predisposed to believe that they are also brilliant, honest, and a capable capital allocator. We allow the halo of their charisma to blind us to potential red flags. Visionary storytelling CEOs are particularly adept at creating this effect. They sell a grand vision of the future, and investors get so caught up in the narrative that they neglect to perform the necessary due diligence on the CEO's actual track record and character. Buffett's third filter is a deliberate and systematic process designed to break through the halo effect. He forces himself to look for concrete evidence of both ability and integrity, separating the sizzle from the steak. He understands that a CEO's primary job is not to be a media personality. It is to be a master capital allocator. The company generates cash, and the CEO must decide what to do with it. Reinvest it in the core business, make acquisitions, pay dividends, or buy back stock. The quality of these decisions over a long period is the ultimate measure of a manager's ability. To assess integrity, Buffett looks for something he calls the institutional imperative, which is the tendency for organizations to mindlessly imitate their peers, no matter how foolish the behavior. A manager with true integrity is willing to look foolish in the short term to be right in the long term. They are willing to sit on a pile of cash when acquisition prices are too high, even when Wall Street is clamoring for them to do a deal. They're willing to admit mistakes openly in their shareholder communications, rather than spinning a narrative of uninterrupted success. This kind of behavior runs counter to the natural human desire for social proof and acceptance. It requires a deep-seated rationality and a commitment to serving the long-term interests of the shareholders above their own ego or short-term compensation. By creating a mental checklist that explicitly demands evidence of both skill, capital allocation, and character, candor and rationality, Buffett protects himself from being seduced by the superficial charm of a charismatic but ultimately value-destructive leader. How can an outside investor, who doesn't have the luxury of sitting on a board with these CEOs, apply this filter in a practical way? The blueprint is a three-part management audit I call the 3 C's: candor, capital allocation, and compensation. This is a crucial part of the due diligence process that focuses on actions, not words. The first C is candor. The single best source for this is the company's annual shareholder letters. Your task is to read the last 5 years of these letters. Are they filled with clear, simple language that a reasonably intelligent person can understand? Or are they dense with corporate jargon, buzzwords, and meaningless platitudes? More importantly, does the CEO openly discuss the company's failures and challenges? Or is every year presented as another record-breaking success? A manager who is willing to publicly admit a mistake, explain what they learned, and how they will avoid repeating it, is displaying a high degree of intellectual honesty and trustworthiness. Look for humility and transparency. The second C is capital allocation. This is the ultimate test of a manager's ability. You need to investigate how the company has used its free cash flow over the past decade. You can find this information in their annual reports. Have they made a string of large, overpriced acquisitions that have destroyed shareholder value? A phenomenon Buffett calls diversification. Or have they been disciplined, only buying businesses that they understand and that are available at a reasonable price? Have they been buying back their own stock? If so, did they do it opportunistically when the stock was undervalued? Or did they buy it back at market highs, which is often a sign they are just trying to prop up the stock price to meet executive compensation targets? A great CEO thinks like an owner, and their capital allocation decisions will reflect a long-term, value-oriented mindset. The third C is compensation. Look at the proxy statement, which details the pay of the top executives. Is their compensation structure aligned with the interests of long-term shareholders? Are their bonuses tied to metrics like return on invested capital or growth in intrinsic value per share? Or are they tied to short-term metrics like quarterly earnings or the company's stock price, which can incentivize reckless, short-sighted behavior? Is the overall level of compensation reasonable, or is it obscenely high compared to the company's performance? A management team that gets rich alongside shareholders is a good sign. A team that gets rich at the expense of shareholders is a massive red flag. By methodically working through these 3 C's, you can build a remarkably accurate mosaic of the quality and integrity of a company's management. The antithesis of this careful, evidence-based approach is the all-too-common mistake of falling for the cult of the visionary CEO. This is the path of the 99%, where investors become so entranced by a leader's charisma and grand promises that they abdicate their responsibility to perform basic due diligence. The corporate landscape is filled with cautionary tales of this folly, But none is more emblematic than the story of Enron and its CEO, Ken Lay. In the late 1990s, Enron was the darling of Wall Street. It was presented as a revolutionary company that was changing the energy industry, moving from a simple pipeline company to a sophisticated trading platform for energy contracts and other exotic financial instruments. Ken Lay was a charismatic, politically connected leader who sold a compelling story of innovation and endless growth. The company's financial statements became increasingly complex and opaque, filled with off-balance sheet entities and convoluted accounting that no one could fully understand. But any skepticism was drowned out by the chorus of praise from Wall Street analysts and the business press. Investors who questioned the company's reported earnings were dismissed as being unable to grasp the new economy. They were investing in a story, not a business. They were placing their faith entirely in the hands of a management team that projected an aura of brilliance and success. They saw the soaring stock price and assumed it was a reflection of a healthy underlying business. In reality, Enron was a house of cards, a massive fraud where the management was using accounting tricks to hide billions of dollars in debt and losses. When the fraud was finally exposed in 2001, the company collapsed into bankruptcy almost overnight, wiping out the life savings of thousands of employees and investors. The story of Enron, along with other similar scandals like WorldCom and Tyco, is a brutal lesson in the danger of ignoring the third filter. It demonstrates that a brilliant and charismatic management team, when devoid of integrity, is not just a risk, it is a potential weapon of mass financial destruction. The 99% are drawn to the flame of a compelling narrative spun by a visionary leader. The intelligent investor knows to first check the quality of the firewood and the integrity of the person holding the match. The direct financial connection between management quality and your investment returns is concrete and inescapable. It all comes down to the concept of compounding intrinsic value. Warren Buffett has a simple test for a CEO. For every dollar of earnings that the company retains, does the CEO create at least $1 of market value for the shareholders over the long term? A great manager, through wise capital allocation, will consistently turn $1 of retained earnings into much more than $1 of future market value. They will invest that dollar in projects with high rates of return, make savvy acquisitions, or buy back stock when it is cheap. This causes the intrinsic value of the business to grow at a high rate, and over time, the market price will follow. This is the engine of wealth compounding. A poor manager, on the other hand, will destroy value. They will take that dollar of retained earnings and squander it on overpriced acquisitions, wasteful capital expenditures, or ill-conceived ventures outside of the company's circle of competence. They will effectively turn $1 of shareholder capital into 80 cents, or 60 cents, or even less. You can see the results of this directly on the company's financial statements over time. A company with great management will show a steady increase in its book value per share and a high and sustainable return on equity. A company with poor management will see its book value stagnate or decline, and its return on equity will be volatile and mediocre. The choice of management is not a soft, fuzzy issue. It is the single most important factor determining what happens to the cash a business generates. A business can be a wonderful horse, but if the jockey is constantly steering it into walls, you will never reach the finish line. By making a rigorous assessment of management quality a non-negotiable part of your investment checklist, you are ensuring that the people in charge are not just running the business, but are actively and intelligently building your wealth alongside their own. Only after a company has passed the first 3 rigorous tests, it is understandable, has a durable moat, and is run by able and trustworthy managers, does Buffett proceed to the 4th and final filter. This is the one most associated with value investing, the question of price. The filter is the stock available at an attractive price? This sequence is critically important. Most investors start and end their analysis with the price. They look for stocks that are going up, or stocks that look cheap, based on some simple metric. Buffett believes this is a fatal error. The quality of the business must be established first. Only then is it appropriate to consider the price. His guiding principle here is Benjamin Graham's famous concept of the margin of safety. You must buy a security at a significant discount to your estimate of its underlying or intrinsic value. This margin of safety serves two purposes. It provides a cushion against errors in judgment or bad luck, and it is the ultimate source of above-average returns. Price is what you pay. Value is what you get. The goal of the fourth filter is to ensure that the price you pay is substantially below the value you are receiving. The most dramatic story of Buffett applying the margin of safety principle is his investment in American Express in the mid-1960s, an event that became known as the salad oil scandal. Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, had perpetrated a massive fraud. They had secured huge loans using barrels of salad oil as collateral. The problem was, the barrels were mostly filled with seawater, with only a thin layer of oil on top. When the fraud was discovered, Allied Crude went bankrupt, leaving its lenders, and by extension, American Express, who had guaranteed the receipts, on the hook for what was then a staggering sum, over $60 million. Wall Street panicked. The conventional wisdom was that the scandal would bankrupt American Express. The fear was that the loss of confidence would spread to its core businesses, the traveler's checks, and the iconic American Express credit card. The company's stock price was eviscerated, plunging by more than 50% in a matter of weeks. This is where Buffett's rational, business-focused approach shone through. While everyone else was focused on the scandal and the plunging stock price, Buffett asked a simple question: has the scandal permanently damaged the company's core economic franchise? To find the answer, he didn't rely on Wall Street reports. He did his own scuttlebutt research. He went to restaurants and travel agencies. He talked to merchants and customers. He asked them if the salad oil scandal had changed their perception of American Express travelers' checks or their willingness to accept the American Express card. The answer he got was a resounding no. The average consumer and merchant either didn't know about the scandal or didn't care. They still saw the American Express brand as a symbol of trust and financial security. He realized that the company's economic moat, built on its brand and its payment network, was completely intact. The scandal was a huge but ultimately survivable one-time loss. He calculated that after writing off the entire loss, the company's intrinsic value was still far, far above its current market price. The market, in its panic, was offering him a dollar bill for 40 cents. He saw a massive margin of safety. He acted with incredible conviction, investing 40% of his partnership's capital, the largest single investment he had ever made, into American Express stock. As the company absorbed the loss and the market's fear subsided, the stock price roared back. The investment was a home run, and it cemented Buffett's reputation as a brilliant contrarian investor. It was a perfect demonstration of the fourth filter, waiting for a wonderful business to be offered at a ridiculously attractive price, propelled by the irrational fear of others. The psychological principle that creates these opportunities is one of the most powerful forces in financial markets: loss aversion. This concept, central to the work of Nobel laureates Daniel Kahneman and Amos Tversky, describes our tendency to feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain. This asymmetry has profound implications for investor behavior. When the market is falling and the value of our portfolio is shrinking, the emotional pain is intense. This triggers our primal fight-or-flight response. Our rational, analytical brain is hijacked by our emotional, fearful brain. The overwhelming impulse is to sell, to make the pain stop, regardless of the underlying value of the assets we own. This is what creates panics and crashes. Buffett personifies this irrational market behavior with his famous parable of Mr. Market. He asks us to imagine that we are partners in a business with a manic-depressive man named Mr. Market. Every day, Mr. Market shows up at our door and offers to either buy our share of the business or sell us his, at a price that reflects his mood. Some days he is euphoric and quotes a ridiculously high price. Other days he is despondent and offers to sell his shares for a fraction of their true worth. Buffett's point is that Mr. Market is there to serve you, not to guide you. You are free to ignore him on the days he is euphoric. But on the days he is gripped by fear and pessimism, like during the salad oil scandal, he presents you with an opportunity. The intelligent investor is not swayed by Mr. Market's mood swings. They have done their own homework, they have their own estimate of the business's intrinsic value, and they use Mr. Market's depressive episodes to buy wonderful businesses at bargain prices. The fourth filter, the insistence on a margin of safety, is a psychological discipline. It's a pre-commitment to only act when the odds are overwhelmingly in your favor. It forces you to be a business analyst, not a market forecaster. It protects you from the emotional contagion of the crowd and allows you to exploit the predictable irrationality that stems from our innate loss aversion. So how can an individual investor create a practical blueprint for determining an attractive price? While a full discounted cash flow analysis can be complex, you can use a simplified, back-of-the-envelope valuation method to get a rough estimate of a company's intrinsic value. This process won't give you a precise number, but it will give you a ballpark figure to help you identify a potential margin of safety. First, you need to find the company's average earnings per share, EPS, over the last 10 years. Using a 10-year average smooths out the effects of economic cycles and one-time events, giving you a better picture of the company's normalized earning power. You can find this data on most financial websites. Second, determine a conservative estimate for the company's future growth rate. Do not use the heroic projections of Wall Street analysts. Look at the company's past growth rate, consider the size of the company and its industry, and pick a realistic, conservative number. For a large, stable company, this might be 5%. For a smaller, faster-growing one, it might be 10%. Third, project the earnings per share out for the next 10 years based on this growth rate. Fourth, you need to estimate what the stock's price-to-earnings PE ratio will be in 10 years. A good rule of thumb is to use either a PE of 15, which is a historical market average, or the company's own average PE ratio over the last decade, whichever is lower. Multiply your projected EPS in year 10 by this PE ratio to get a future stock price. Fifth, you must discount that future stock price back to today's value. A common discount rate to use is 10%, which represents a reasonable expected annual return. The formula for this is present value equals future value / 1 plus discount rate / number of years. Finally, you have your estimate of the company's intrinsic value per share. Compare this number to the current stock price. Is there a significant discount? Is the stock trading at 50, 60, or 70% of your estimated value? If so, you may have found a significant margin of safety. This is a crucial step in the stock screening process, transforming a qualitative assessment into a quantitative decision framework. The antithesis of this disciplined, price-conscious approach is the mindset of growth at any price. This is the path of the 99% who become so enamored with a great business that they convince themselves that the price they pay is irrelevant. The classic historical example of this folly was the Nifty 50 bubble of the early 1970s. The Nifty 50 were a group of about 50 large-cap, blue-chip stocks that were considered to be one-decision stocks. You just had to buy them and hold them forever. The list included wonderful companies with dominant market positions and strong growth prospects, companies like Xerox, Avon, Polaroid, and McDonald's. They were, by any measure, fantastic businesses that passed the first 3 of Buffett's filters with flying colors. The problem was the price. The mania for these stocks became so extreme that their PE ratios were bid up to astronomical levels, 50, 80, even 100 times earnings. The prevailing wisdom was that their growth was so certain and so rapid that no price was too high to pay. Then came the brutal bear market of 1973-1974. The economy soured and the market crashed. The Nifty 50, despite being wonderful businesses, were not immune. Their stock prices collapsed. Xerox fell by over 70%. Avon fell by over 85%. Polaroid fell by over 90%. An investor who bought these great companies at the peak of the bubble suffered catastrophic losses, and in many cases, it took more than a decade just to get back to even. The lesson was brutal and clear. A wonderful company can be a terrible investment if you pay too high a price. The margin of safety is not an optional extra. It is an absolute necessity. The 99% fall in love with the story of a great company. The intelligent investor falls in love with the mathematics of a great company bought at a great price. They understand that the starting valuation is one of the most important determinants of your ultimate return. The direct financial connection between the margin of safety and your portfolio's performance is the most direct of all four filters. It is the mathematical engine of your returns and your primary defense against risk. When you buy a stock at a 50% discount to its intrinsic value, you are building in a massive cushion for error. Your analysis of the company's moat might be slightly off. Your projection of its future growth might be too optimistic. The management might make a strategic misstep. If you paid full price, any of these events could lead to a permanent loss of capital. But with a large margin of safety, the business can underperform your expectations, and you can still earn a satisfactory return, or at the very least, get your initial investment back. It is your shield against the uncertainties of the future. Simultaneously, the margin of safety is the source of your profits. Investment returns are generated by the closing of the gap between price and value. When you buy a stock for 50 cents that is worth $1, you have a potential 100% return. The return comes not from the company's growth, but from the market's eventual re-rating of the stock to its intrinsic value. The growth of the business then provides an additional layer of return on top of that. This combination of a re-rating and business growth is what creates the multi-bagger returns that define a successful value investing strategy. A portfolio built on the principle of margin of safety is a portfolio with limited downside and significant upside. It is a financially and psychologically robust way to build wealth over the long term. It transforms investing from a speculative gamble into a disciplined, business-like operation where the odds are systematically stacked in your favor. We have now deconstructed the four critical filters that form the foundation of Warren Buffett's investment philosophy: the circle of competence, the durable moat, able and trustworthy management, and the margin of safety. But the true genius of this framework lies not in the individual pillars, but in their synthesis. It is a sequential, integrated decision-making process, a ruthless elimination tool designed to combat the greatest enemy of the investor, analysis paralysis. The four filters are not a menu of options to be picked and chosen from. They are a lock with four sequential tumblers. A company must click through each one in order to be considered a worthy investment. A failure at any single step means immediate disqualification. This discipline is what makes the process so efficient and so powerful. There is a story that perfectly illustrates this sequential discipline in action: Buffett's decision to consistently avoid investing in Microsoft during its period of explosive growth in the 1990s. This was a decision that baffled many observers. Buffett and Bill Gates were, and still are, close friends. Buffett had a front-row seat to the meteoric rise of the company. Let's run Microsoft through the filters from Buffett's perspective at the time. Did it have able and trustworthy management? Absolutely. He considered Bill Gates to be one of the most brilliant and driven managers in the world, so it passed filter 3 with flying colors. Was it available at an attractive price? For much of its early history, probably yes, given its phenomenal growth. It likely passed filter 4. Did it have a durable economic moat? Unquestionably. The Windows operating system and the Office software suite had created one of the most powerful network effects and highest switching costs the business world has ever seen. It was a textbook example of a deep, wide moat, so it passed filter 2. But it failed at the very first gate, filter 1. Is it a business I can understand? Buffett, by his own admission, did not feel he understood the technology well enough to confidently predict what the competitive landscape would look like in 10 or 20 years. He didn't have a deep understanding of software architecture or the dynamics of technological change. He knew Microsoft was a phenomenal business, but it was a business that existed outside of his circle of competence. And because his process is sequential, that single failure was enough. The no at filter 1 meant he didn't have to waste a single minute of mental energy considering the other 3. This demonstrates the incredible discipline of the system. He was willing to miss out on one of the greatest wealth creation machines in history because it violated his first and most important rule. He didn't let the fear of missing out, or his friendship with Gates, or the allure of massive profits tempt him into a game he didn't understand. The system protected him from his own potential for error. The underlying psychological principle that this synthesized system addresses is the dual threat of decision fatigue and analysis paralysis. Our brains have a finite amount of high-quality decision-making energy each day. When faced with an overwhelming number of choices and an infinite amount of data, as is the case in the stock market with its thousands of publicly traded companies, our cognitive resources become depleted. This leads to one of two outcomes. The first is analysis paralysis, where the investor becomes so overwhelmed by the sheer volume of information that they are unable to make any decision at all. They spend all their time researching and none of their time investing. The second, and equally dangerous outcome, is that they make poor, impulsive decisions based on cognitive shortcuts, like buying a stock simply because it was mentioned on the news. The 4 filters framework is a powerful antidote to this. It is a structured heuristic, a mental shortcut that dramatically simplifies the decision-making process. By turning the investment question into a simple 4-part yes-no checklist, it reduces the cognitive load required to evaluate an opportunity. The sequential nature of the filters is the key to its efficiency. You are not trying to evaluate all 4 aspects of a business simultaneously. You are asking one simple question at a time. A no answer at any stage terminates the process, conserving your precious mental energy for the few opportunities that truly deserve it. It is a system for saying no 99 times so that you can say yes with immense conviction and clarity. This is the essence of effective executive decision-making. The blueprint for synthesizing these 4 filters into a single, rapid triage process is what this entire journey has been leading to, the 15-minute investment triage. This is a practical routine you can use to screen any stock idea and decide if it is worthy of a place in your deep research pile. Here is how it works. You have 15 minutes on the clock. For the first 3 minutes, you focus exclusively on filter 1, the circle of competence. Your only goal is to answer the question, can I explain this business, its customers, and its key risks in simple terms? Pull up the company's website or its About Us page. If you cannot grasp the core business model almost instantly, you stop. The company is discarded. If you can, you proceed. For the next 4 minutes, minutes 4 through 7, you focus on filter 2, the durable moat. Go to a financial website and look at the company's historical gross margins and return on equity. Are they consistently high and stable? Try to identify the source of its moat using the 5 forces checklist. Can you name it? Is it a brand, a network effect, a switching cost? If you can't find clear evidence of a durable moat, you stop. The company is discarded. For the next 4 minutes, minutes 8 through 11, you tackle filter 3, management quality. This is a quick and dirty version of the 3 C's audit. Pull up the most recent shareholder letter. Skim it for a minute. Does it sound candid and transparent, or is it filled with corporate jargon? Do a quick search for CEO name, capital allocation. See if you can find articles or interviews where they discuss their philosophy. Any obvious red flags, like a history of value-destructive acquisitions. If you feel a sense of unease about the leadership, you stop. The company is discarded. Finally, for the last 4 minutes, minutes 12 through 15, you assess filter 4, an attractive price. This is not a full valuation. This is a quick temperature check. Pull up a 10-year chart of the company's P/E ratio. Is it currently trading at the low end of its historical range or the high end? Does a very quick back-of-the-envelope calculation suggest a potential margin of safety? If the stock looks obviously expensive relative to its own history and its future prospects, you stop. The company is discarded. If, after 15 minutes, a company has managed to pass through all 4 of these gates, you have found something special. It is one of the rare 1% of opportunities that is worthy of your most valuable asset, your time and deep analytical focus. This triage process transforms you from a random stock picker into a systematic investment hunter. The antithesis of this systematic approach is what I call the diversified collector. This is the path followed by the vast majority of amateur investors. Their portfolio is not the result of a disciplined process. It is a random collection of 50 different stocks, an incoherent scrapbook of past investment fads and hot tips. They might own a cannabis stock they bought after reading a headline, a tech stock that a friend recommended, a bank stock because they use their services, and a biotech stock because they have a vague hope it will cure a disease. There is no unifying philosophy, no checklist, no rhyme or reason to their holdings. They have confused activity with progress. They are constantly buying and selling, reacting to news and chasing performance. Their investment strategy is a chaotic, random walk through the market. This approach is not only ineffective, it is actively harmful. They incur massive transaction costs from frequent trading. They create a tax nightmare for themselves. And because they don't truly understand what they own, they are prone to panic selling at the bottom and greed buying at the top. Their portfolio, a hodgepodge of mediocre ideas, ultimately performs no better and often worse than a simple, low-cost index fund, but with far more stress, effort, and cost. It is the perfect recipe for mediocrity, a surefire way to ensure you never achieve true financial literacy or freedom. The ultimate financial connection of the synthesized 4 filters system is the dramatic improvement in the efficiency of your 2 most precious resources, your time and your capital. Think of the thousands of hours that investors waste researching, reading about, and worrying about companies they should have never considered in the first place. This system allows you to eliminate 99% of those distractions in a matter of minutes. The time and mental energy you save is then redeployed with laser-like focus on the tiny handful of truly exceptional opportunities that pass the full screening process. This is a force multiplier for your intellectual efforts. It ensures that your deep research, your most valuable work, is only performed on the highest probability candidates. This dramatically increases the quality of your final investment decisions. The result is a concentrated portfolio of high-quality, well-understood businesses bought at attractive prices. This is the mathematical and strategic foundation for superior long-term returns. It is not about being smarter than everyone else, it is about having a more disciplined process. This framework is not just a tool for stock analysis, it is a complete operating system for rational decision-making in the face of uncertainty. It is the bridge from speculation to professional-grade investing. It is the key to unlocking the power of compounding and achieving genuine, lasting financial freedom. You have just spent this time acquiring a powerful mental tool. You now possess the 4-part mental lens that Warren Buffett uses to bring the entire, chaotic world of business into sharp, immediate focus. You have the framework to cut through the noise, to instantly separate the investable from the ignorable, and to protect yourself from the most common and costly errors. This is more than just information. It is a complete upgrade to your decision-making hardware. But mastering this initial filtering process is only the first crucial step on the path to becoming a true capital allocator. The 4 filters are designed to answer one question: what should I buy? But Buffett's system is a network of interconnected mental models that answer a whole series of equally critical questions. How does he handle the immense psychological pressure after stores he buys when a stock continues to fall? What is the framework he uses for deciding when, if ever, to sell a wonderful business? How does he structure his portfolio to balance concentration and risk? These are not separate skills. They are integral parts of a unified philosophy of wealth compounding. The algorithm has analyzed your commitment to mastering this first foundational piece, and it has already queued up the next link in that chain. The video on your screen right now is not an accident. It is the next piece of the map. the component that connects your buying decision to the long-term strategy of holding and compounding. Most people will stop here, content with a single tool, believing they have the whole picture. But you didn't watch this far to be average. You are here to build a complete mental arsenal. The choice to click is more than just a choice to watch another video. It is a choice to continue your ascent, to complete the architecture of your financial mind. The link that connects everything you've just learned to the art of long-term ownership awaits. The next piece of the map is on your screen. Continue the journey.